Attention! This video is intended for the purpose of educating and understanding the Forex market. It is not created to induce investment. Investment is risky. Therefore, investors should study information before making an investment decision.
Welcome back to the chapter 5. We're going to learn more in the deeper details about the topic of the MT4, how to use it, setting about the take profit and stop loss point, learning about the type of the traders, and move to the parts of attitude adjustment and correcting false beliefs. Then move on to the part of money management, position sizing, risk and reward, and end up with the part of psychology and risk management. Let's get to know how to set stop loss and take profit through MT4. When we have opened an order in MT4 and then we choose set a stop loss or loss and take profit or profit point by right-clicking on the order that we have opened. Select Modify or Delete Order menu, and there will be a window on the right side which will have a stop loss and take profit menu. Then we can use the price that we want and click on the menu, modify the order below to confirm the order. And once you have confirmed the order, you will have the details of stop loss and take profit. Then click OK, and the order we have set will come up to the order below. Let's learn how to set sell stop, sell limit, buy stop, buy limit, where MT4 programs. These four orders are futures orders that open only if the conditions we have set are met. We can create orders by double-clicking on the currency pairs on the left in the currency pairs that we need to. Then there is the order window on the right. Select the type menu, change to pending order. Then look at the pending order section below. We will see the options of buy limit, sell limit, buy stop, and sell stop. Then choose the order you want. Once we have selected the command we want, we can set the desired price in the Add Price box. Then press Paste to confirm the order. It is completed to preset the order. Now let's move on to the part of the type of the traders. It is important to learn about the type of the traders and are often overlooked, where each type of the traders have different trading methods, as well as choosing the right security for the different trades. So the question is, how many types of the traders are there? There are three main categories: fundamental traders, new traders, and technical traders. So let's get started with the first type of the traders, such as fundamental traders. This type of the traders are people who are required to keep up to date with the world economic figures and fiscal policy in all countries. The news traders, who's going to be this type of trader, is often decided by violent events, for example, announcements, breaking news, economic reports, or other events. This could have a short-term impact on price movement and can be used to analyze the data and profit from what is likely to be. Technical traders trade with own tools or system and usually analyze from the resulting graph by finding the most convenient and handy tool in order to make a profit in the market. After we have learned about the type of the trader and check yourself what type of who you are, then it's time to learn about the trading behaviors. Let's see what type that you want to be in the details. Let's get started with the first one, precision trader. Traders who hold order for weeks or months or can be sometimes be a year long. The fundamentals and trends of the market are studied for a long period of time before its trading starts. The swing trader. The time it takes to place an order is less than the precision trader, which can be days or weeks when a resistant order is opened, supported, or traded during the chart-changing trend. Thirdly, day trader. This tribe of traders will not let orders be placed by the night and finish their orders each day, and may wait in minute or hour. And lastly, scalpings. This type of traders issue several trading orders per day and use a program to analyze charts. Now let's move on to the part of attitude adjustment and correcting false beliefs. Many traders want to see the market at any moment because they think it's good to watch at the chart all times, but it's soon understood that it has nothing to do with better trading. Some investors reduce their time with screens, their success rate are even higher. Therefore, investors must specify the most appropriate time to trade and then off the screens. Many traders believe that the more indicators they use, the more profitable they will get. Every order opened must be profitable. In fact, there is no way to make 100% profit. Many people try to use only the best setting, but that doesn't make investors profitable from every order traded. But we can control the leaks that arise. The more trades you trade, the more money you make. But don't forget that every order opened doesn't mean you can earn every order. We should focus on the order we will trade, whether they are effective enough to open an order. Because if we open a lot of orders but are not quality, that may cause investors to lose more than they profit. Let's learn about money management or MM. Money management refers to investor capital managing in terms of profitability and loss. If investors are applying money management principles to forex trading, they will be able to use money management. Here are some examples. When profits are made, withdrawal should be made regularly. If you trade longly for more than 4 consecutive times once in a day, you will have to stop trading and rethink your trading strategy. Aim for what profit per day, around 3 to 5% of capital. Aim to cut loss when the loss per order is not over 3%. Position sizing. Position sizing is risk management by limiting losses. It is one of the tools used to control risk. Traders who do not reconfirm the size of the order to trade are at high risk. 3 steps to optimize size. Position scaling involves a number of trades and this tends to adjust the risk of each order to meet the requirements of our own system. The steps for resizing a position are as follows. Step 1. Measure loss stops. The first thing that is required to calculate the position size is stop loss. Step 2. Determine the risk you can take. This is the trader's job to take risks. It is risky to say that in each trade we allow the maximum loss of the full amount compared to the port size. Step 3. Determine lot size and pip values. In forex trading, the position size is indicated by the number of lots open per trade. There are usually 3 types of lots in forex trading. The main categories are standard lot, mini lot, and micro lots. It depends on what types we choose to trade. Each pip values are different. Now let's take a look in the details about the relationship you should know about risk and reward. Risk-reward ratio, or RRR, is the proportion compared to the risk. It is the loss of money compared to the amount of money you will receive, whether it is worth taking risks to invest each time. In each trade you will be placed in, trader can use the stop-loss method according to the risks. Take profit will be placed according to the reasonable price target depending on the trader's strategy. Predefining RRR allows traders to invest systematically. Risk, the risk of stock price falling down to a stop loss. reward, expected return, or take profit. The guidelines are that the value of the reward should be greater than risk value in every time the trader makes a trade. It can be said that no matter how well investors can read the chart or analyze the price direction, if they do not know the correct money management, it is difficult to succeed in trading. Psychology, or trading psychology. Mindset of 5% of people who have made long-lasting profits on the Forex market. Mindset in trading is the one that says whether the trader will succeed. Let's see what factors to consider. Firstly, trade above emotion. Emotions are the driver of decision making. People often buy on greed hoping for profit. Instead, it sells on fear of losing profit. Because of this, it is unsuccessful to make profits in Forex market. For traders who want to succeed, they're not going to let their emotion affect their decision. Instead, it relies on our information regionally, both fundamentals and technical, on knowing how to wait for the right moment. Secondly, always be ready, because the market never stops. The market can change over time according to the situation. When the market changes, the chart changes, trader needs to catch up on the situation to find the pace of profitability. Lastly, don't stick to what passed. A good trader must live with the present and follow what is happening. Sticking to the past can undermine our confidence and result in highly wrong decisions. For example, you just lost a stock, the next day another good trading signal occurred, but you didn't have the courage to buy it because you remember this stock has hurt you before. Remember that every trade is a new start and a chance to win this one. There is no connection to the past. Let's move on to the last topic about risk management and how to diversify and avoid margin call forever. Risk management is a risk management from Forex trading, which will result in a high chance of profitability, and how to avoid margin call forever. Firstly, do not move the specified intersection several times because you think you are right, so you can postpone the stop loss to expect what you have set out. Or the last trade you just hit the cutoff point and then the price went on. That's why the trader thought that would be like that again. This will lead to multiply the damage. Secondly, the long-term profit is assured that it sells at the highest price, so it opens short immediately. Do not forget that we cannot know the highs and lows of the market price. Opening an order like that will cause significant risks. Thirdly, all in, using margin to open full port status. Many investors may think that if trade in the right way will make a large profit, but remember that if trade in the wrong way, this will cause significant damage to investors. Trading is not a gamble, but is it the best to study position sizing, opening and using margin fund appropriately so that margin calls are not formed. Fourthly, there are signs of buying and not daring to buy. This is due to the bias that when previous trading results came out, losses were consistent several times. Therefore, even if the purchase signal is completed according to the system laid out, traders still don't have to open orders. Investors need to change the way they think. Each trade is independent of each other. Lastly, open orders not matching the specified trading system. There is negligence in opening orders without waiting for them to match the system in place, which has a lot of losses.
Or you can have it here in our service and products, Trading with Neowin FX. Contact us for more at neowinfx.com or to scan our QR code right in front of you. We are here to assist you anytime.